welcome to our lesson 4. Lesson 4 is going to touch on minerals and mining operations. You see, taxation of minerals and mining operations. So we are looking at the principles of taxation, and it can be seen in section 67 of Act 896. The minerals income tax payable shall be calculated for the year of assessment by applying the rate of 35% to the chargeable income of that person from the mineral operation. So just like we looked at petroleum operation, mining operations, their chargeable income are also taxed at what? 35%. In fact, most of the principles underlying petroleum operations does not change mainly from mineral operations. So as we go along, I'll be telling you the comparison. It's very, very important, so that once you know one, you know for the other one as well. Okay? So where a person has a chargeable income other than income derived from the mineral operation, that income shall be charged to tax accordingly. That income shall be charged to tax. For the purpose of ascertaining the assessable income from the mineral operations of a person, again, each separate mineral operation and any other activity of the person conducting the mineral operation, as though the arrangement was conducted between the persons who are in controlled relationships. The transfer of an asset to or from a separate mineral operation is treated as an acquisition or disposal of that asset. Okay, and this is what we looked at when we're even looking at the petroleum operation under the concept of separate petroleum operation. Here too, under the concept of separate mineral operation, the transfer of an asset to or from a separate mineral operation is normally treated as an acquisition or disposal of the asset. Now, where two or more persons hold a mineral right under an arrangement other than a partnership, the assessable income from a mineral operation of each person shall be calculated separately. So please, the concept of separate mineral operation is also touching on the same things as we explained under the petroleum operation. Okay, so under the concept of separate mineral operation, where two or more persons hold a mineral right under an arrangement other than a partnership, the assessable income from the mineral operation of each person shall be calculated separately, and be calculated as if they were persons in a controlled relationship. Okay, so now let's come to the topic proper. The topic proper is separate mineral operation. So one of the things that when you are learning, you have to learn is the issue of separate mineral operation. Is the issue of separate mineral operation, and that is section 78 of Act 896. Please, it's important to know the meaning of separate mineral operation. Very, very important. Now, what does we mean by the concept of separate mineral operation? Okay, under this particular concept, okay, the following shall constitute a separate mineral operation. See, the moment you begin to explain this way, then you are explaining the concept of separate mineral operation. A mineral operation pertaining to each mine. You see, when you are looking at the concept of separate mineral operation, you have to look at the mineral operation which is pertaining to each mine. Any mineral operation of a person pertaining to each mine must be treated separately. It's very, very important. And the mineral operation with a shared processing facility. So please, these two things we will touch on them. Okay. Now, where a person holds a reconnaissance license. Now, the word reconnaissance means searching for the minerals. Searching for the minerals. You know, before you can start the mineral operation, you must hold a reconnaissance license. And the reconnaissance license is a license given to you to first search for the mineral. So, where a person holds a reconnaissance license and is subsequently granted a prospecting license. So, note, before you are granted a prospecting license, you must first have the reconnaissance license. The reconnaissance license is a license given to you to search for the minerals. Then, having discovered or find out that there is a mineral deposit in a particular mine, okay, then you have to apply for a prospecting license. The prospecting license is now trying to develop that particular area to be able to ascertain the commercial viability of the mineral operation. That's a prospecting what? License. The reconnaissance license is what? Is a search for the minerals. The license given to search for the minerals. And having searched for the minerals, and you are able to detect that there are mineral deposits in a particular mine or area, okay, you need to apply for what? A prospecting license. And that prospecting license is now you giving a license to develop that area to be able to mine, the possibility of mining that area in commercial what? Quantity. In commercial quantity. Very important. So please, I've talked about the reconnaissance. So here the point they are saying is that if you are discussing the concept of separate mineral operation, you have to say that where a person holds a reconnaissance license and is subsequently granted a prospecting license, a mineral operation conducted with respect to that reconnaissance license before the grant of the prospecting license is conducted with respect to the prospecting license. In other words, it is conducted with respect to the latter. So please, where a person is what? Granted a reconnaissance license, that's a license to search for the minerals, and is subsequently granted what? A prospecting license. Please, under the concept of separate mineral operation, please, the mineral operation conducted with respect to the reconnaissance license before the grant of the prospecting license is conducted with respect to the prospecting license. Okay. Number 2, conducted with respect to the same separate mineral operation. Okay, so it means that what you are conducting is in respect to the same separate mineral operation, not different mineral operation, because you were given a reconnaissance license and subsequently you are given a prospecting license. So whatever mineral operation that you are conducting, it is being conducted with respect to the same separate mineral operation. Okay. Now, where a person holds a prospecting license, so now you have moved from reconnaissance license and you were subsequently given a prospecting license. They say what you are operation that you are conducting is in respect to the prospecting license. Now, but where a person holds a prospecting license and is subsequently granted a mining lease, okay, the mining lease now is the license given to now to do the mining itself. And the area which is subject of the mining lease falls wholly within the prospecting area. A mineral operation conducted in relation to the prospecting license before the grant of the mining lease is conducted with respect to the mining lease. That is in respect of the latter. Okay? And conducted with respect to the same, and what you are conducting is being conducted with respect to the same separate mineral operation. The only thing is that what? You have moved from what? A prospecting license, then to a mining, you are now given a mining lease. You know, having developed the area, now you want to now mine in commercial quantity. So you need to obtain what? A mining lease. You need to obtain a mining lease. You need to operate a mining lease. Okay. So then in that case, what I'm saying is that whatever operation that you are conducting, they say it is being conducted with respect to the mining lease. And it is in respect of what? The same separate mineral operation. Now, where a person holds a mining lease and now is subsequently granted approval for the mining area, which area within the area which is subject of the mining lease, then the mineral operation conducted with respect to the mining lease before the approval of the mining area is conducted with respect to the mining what? Area. So you have seen the trend. So now you have been given a mining lease and you are now being given a license with respect to the mining area. So whatever operation that you are carrying out, therefore, it is being seen to be carried out in respect to the mining area. And here it is whatever operation that the person is conducting it with respect to the same mineral operation, not a different mineral operation, the same mineral operation. Because it's just a movement from what? A prospecting license. From the prospecting license, okay, then you are giving the license. If you come back, you will see that from the prospecting license, okay, first of all, you start from the reconnaissance license, and you are subsequently granted what? A prospecting license. They say what you are conducting is research to the prospecting license. Now you are given a prospecting license, and subsequently you are given a mining what? Lease. whatever you are conducting is with respect to the mining lease. Then, and it's with respect to the same mineral operation. Then you are now given the mining lease, and you have obtained a license for the mining area. Therefore, whatever mineral operation you are conducting is with respect to the mining area, and it is with respect to the same separate mineral operation. Very important. Okay. Now, the practice note on separate mineral, what I've just enumerated. Separate mineral operation under Section 78 of the Act means mining operations which involve reconnaissance, prospecting, and the mining for the minerals or the mining of minerals, conducted in respect of each mine. Now, where a person is conducted mineral operation, okay, in 2 or more mines, very important. The first one, if it is in respect of a particular mine, then that is a separate mineral operation, okay. But where a person, so first of all, in discussing, you have to discuss in respect of the same mine, okay, and looking at the license obtained. Now, the second point is this one, where a person is conducting mineral operation in 2 or more mines, okay, and yet the concept of ring fencing is here again. The mineral operation under each mine constitutes what? A separate mineral operation for tax purposes. So here is a company that has 2 or more mines. You don't combine all the mines and then calculate the chargeable income for that company. No. Under the concept of separate mineral operation, where a person is conducting mineral operation in 2 or more mines, the mineral operations under each mine constitute what? A separate mineral operation for what? Tax purposes. Very important point. So under Section 78, Section 1B of the Act, separate mineral operation means mineral operations with a shared processing facility. Now, where a person is conducting mineral operation at different locations. Now, note this point. Now, we are looking at where the mineral operation is being carried out at different locations. But the different locations have to share their processing facility. In other words, the processing facility which is used in one location is also being used in the other location. When that happens, each mine will not be considered as a separate mineral operation on its own because of the fact that they are using the shared processing facility. So please, when you are discussing the concept of separate mineral operation, talk about where they are not sharing the processing facility and then where they are sharing what? A processing facility. Where they are not sharing a processing facility, each mine is seen as a separate mineral operation. And chargeable incomes must be, books of accounts must be kept for each mine. Chargeable income must be determined for each mine. Tax liability must be calculated for each mine, though it is for the same person. But however, where a person is conducting mineral operation at different locations, but please, and always take note of this point, with a shared processing facility, which means that the different locations have to share the same processing facility. In that case, such mineral operations are required to be considered as what? Same separate mineral operation. So it means that for them, though the locations are different, the mines are different, you don't consider each mine to be an operation on its own, but rather, because they are sharing the processing facility, they are considered as what? Same separate mineral operation. Okay. For that matter, the revenue that is derived for each of the mines must be combined. Take note. Because they are sharing the same processing facility, the revenue that is derived from each of the different locations must be put together, so far as that mineral operation is concerned, regardless of the fact that it is at different locations. Please, the reason is because they are sharing what? The processing what? Facility. Okay. Now, where a person is conducting mineral operations now with different processing facilities, have you seen it? Now, the mineral operations relating to each processing facility is required to be considered as what? A separate mineral operation. So please, anytime you are discussing the concept of separate mineral operation, discuss it in terms of what? The sharing of the same processing facility, where the different locations must still be seen as the same separate mineral operation. But where the person is conducting the mineral operation with different processing facilities, the mineral operations relating to each processing facility is is required to be considered as what? A separate mineral operation. So here, books of account must be kept separately, chargeable income must be determined separately, and tax liability must also be computed separately. And this is where, when there is a transfer of an asset from one mine to another, it will be considered as what? An acquisition and what? A disposal. And the same applies to the issue of capital allowances. For the determination of capital allowances, they must share the capital allowances between the two mineral operations to the extent of the assets that you are being using in that particular processing facility. So please, where the processing facilities are different, capital allowances must also be computed what? Differently. And transactions between the different mineral operations must also be done at what? Arm's length. It must be done at where? Arm's length. Very important. Though it's the same person, which you can say that they are in a control relationship, transaction between them must be seen to be conducted at what? Arm's length. When you're using these terminologies, then you're getting the marks. Okay. So under subsection 2 and 3 of section 70 of the Act, mineral operations conducted by a person under a reconnaissance license and subsequently under a processing license, this is what we discussed, and the mining license are required to consider as the same separate mineral operation, where the mining lease is carved out of the processing area, and the processing area is also carved out of what? The reconnaissance license. So once they are all carved from one another, please, it's the same separate mineral operation. Now, for the avoidance of doubt, mineral operations conducted by each person under a reconnaissance license only, that's under the search for the minerals only, is a separate mineral operation. And the mineral operation conducted by a person under a prospecting license only, look at the word lowly, then it's a separate mineral operation. And the mineral operation conducted by a person under a mining lease only is a separate mineral operation. So please, if they are being conducted under a reconnaissance license only, there is a separate mineral operation. But if it is being conducted under a prospecting license only, then, but if one has to be carved from the other, okay, the reference will always be made to the latter, and it will be regarded as the same separate mineral operation. But where it is, one is being conducted and the license is obtained only for that particular one, then that one will be regarded as what? The separate mineral operation. Okay. Now, where a person conducts mineral operations under 2 or more mining leases with one processing facility, such mineral operations constitute what? Separate mineral operation. Okay. So under section 77, subsection 4, each separate mineral operation is required to be treated as what? An independent business. Have you seen it? Once you are able to establish that is each separate mineral operation, please, that is the independent business. And the chargeable income of the person is required to be determined separately from each of the separate mineral operation. That's all. Any person engaged in a mineral operation should therefore keep what? Separate books of what? Accounts. And file tax returns for each separate mineral operation. So when you are discussing the concept, you need to mention all these, that each separate mineral operation is required to be treated as what? An independent business. And then the chargeable income of a person is required to be determined separately from what? Each separate mineral operation. And for that matter, any person engaged in the mineral operation should therefore keep what? Separate books of accounts and also file the tax returns for each separate mineral operation. So we are discussing the concept of separate mineral operation. Okay, so that's all. Now, illustration. A company A is engaged in mineral operations in 2 mines. The law requires that the chargeable income of the company A be determined separately for each mine. That is, and this will be the case where they are not sharing what? Processing facility. B, if company A is engaged in conduct of mineral operations in 2 or more pits under the same mining lease with a shared processing what? Facility, such mineral operations constitute the same separate mineral operation. The chargeable income of a company A should be determined for that separate mineral operation. Okay. So you will see that here company A is engaged in what? The conduct of mineral operations in 2 or more pits. So though the pits are 2, but what is happening? Under the same mining lease, but with what? A shared processing facility. In that case, such mineral operations constitute the same separate mineral operation. It's the same separate because they are sharing the processing facility. chargeable income of the company should therefore be determined for that separate mineral operation. You don't segregate them into two. And this is what we talk about, the transaction between the separate mineral operations. When there's a transaction between separate mineral operations and any other activity, the arm's length principle should apply to transactions or any arrangements between the two or more separate mineral operations of a person. Okay, please don't transact it at non-arm's length. Transactions between the separate mineral operations of the person must be seen to be conducted at what? Arm's length. And between a separate mineral operation and any other activity of that person. This means that transactions between a separate mineral operations and any other separate mineral operation or any other business activities belonging to the same person should be carried out as though they were done between what? Independent what? Persons. Okay. Now, where a person engaged in a mineral operation earns income from a business other than the mineral operation, the chargeable income of that person is required to be determined separately from the mineral operations and other what? Business. I repeat. Where a person engaged in a mineral operation earns income from a business other than what? From the mineral operations, then the chargeable income of that person is required to be determined separately from the mineral operations and the other business. You don't combine the other business with that of the mineral operation. No. Very important. The chargeable income from other business is required to be determined in accordance with the relevant provisions under section 1 of the others, the way incomes are being determined for chargeable income purposes. That is the provisions under section 1 of the Act. So that's all for the concept of separate mineral operation. Now let's look at the issue of financial cost and financial gain. You know, this was discussed when we were doing a petroleum operation. And I mentioned that financial cost arises as a result of the losses that comes from hedge instruments. Okay? Whilst financial gain will be the profit that arises from hedging your instruments, financial instruments. Okay? The question is, how are they treated? The following rules are provided for deducting relevant financial costs under section 81, subsection 4, and under section 81, subsection 7 of the Act. Okay. Like the way, it is the same way we discussed it under the petroleum operation. You don't charge, though financial cost is supposed to be an expense, and financial gain is supposed to be income. You don't add it for accounting purposes. They take it out before arriving at their profit. And for accounting purposes, financial gain will be added to arrive at the profit. But for tax purposes, we don't include it in the financial statement itself. So when it comes to the issue of examination of accounts, we don't add financial gain to income to determine the chargeable income, and we don't subtract the financial cost. But rather, they are there to augment each other, like I told you. So the relevant financial gain or financial cost may be included in ascertaining the chargeable income of a person from a separate operation. But the way it will be included is this. The relevant financial cost is deducted. So please, first of all, you mentioned relevant financial gain or relevant financial costs may be included in ascertaining the chargeable income of a person from a separate mineral operation. But how is it included and how is it deducted? This is sub number 2. The relevant financial cost is deducted only to the extent of the relevant financial gain. It's included in determining the chargeable income of a person from a separate mineral operation. So what they are saying is that to the extent to which you have financial gain to cater for the financial cost, then the financial cost can be subtracted from where the extent of the financial gain. That's the point we made. And that's the same point we made when we discussed the petroleum operation. Now, in the year of assessment, where the relevant financial cost is not allowed as a deduction in determining the chargeable income by virtue of the limitation to the relevant financial gain, such costs may be carried forward and deducted from the relevant financial gain of the subsequent 5 years of assessment. So the point here is that where you don't have sufficient financial gain to absorb the financial cost for the year under consideration, the excess financial cost will be carried forward for a period of 5 years to be charged against subsequent financial gain. Okay? Now, if after 5 years you could not make sufficient financial gain to absorb the financial cost, then that financial cost can no longer be what? Carried forward, and it must be what? Abandoned. This is how we treat financial cost. So what we are saying is that though financial cost can be charged against income, and financial gain can be added to income, in terms of their treatment, what we do is that you subtract financial cost to the extent of your financial gain. Where financial gain is not sufficient to absorb the financial cost, the financial cost can be carried forward for a period of what? 5 years to be charged against subsequent what? Financial gain. If after 5 years, you are telling the examiner that if after 5 years you could not generate enough financial gain to absorb that financial cost can no longer be what? Carried forward. And it must therefore be what? Abandoned. Which means it can no longer be expensed. Okay, that's the point we are trying to make. Okay, so if you look at the issue of relevant financial cost, the point we are making is that the relevant financial cost not allowed as a deduction in determining the chargeable income should be what? Added back to the profit of the separate mineral operation to determine the chargeable income for that year of what? Assessment in which the limitation of the financial cost was what? Effected. So the point you are making is that, let's say you have a financial cost of 1 million and financial gain of only 800,000. Now you will see that the financial cost should be deducted to the extent of the financial gain. So you have to charge the 800,000 out of the financial cost against the financial gain of what? 200,000. 800,000. Which means that the 200,000 is something that you cannot charge for that year. So because of that, since it has already been deducted in arriving at the profit and you want to adjust the profit, you have to add back the remaining 200,000 and carry forward for a period of what? 5 years, following the year in which the financial cost was incurred. We'll look at some illustrations on that. Illustration. The profit of a company from a separate mineral operation is 2 million. An amount of 420,000 and 200,000 in respect of financial costs and relevant financial gain respectively were reckoned in determining the profit from the separate mineral operation. Required. Explain the tax treatment of the relevant financial costs and the relevant financial gain in respect of the derivative instrument and determine the chargeable income of the company from mineral operations. So you come here. Solution. The Act requires that relevant financial costs should be limited to what? The relevant financial gain included in the profit of the company. Even though the relevant financial cost reckoned in determining the profit of the company is 420,000, it has to be limited to the relevant financial gain included in the profit, which is 200,000. Which means that they are only allowing for what? They are only allowing to the extent of the financial gain. That's the point they are making. So the excess of the relevant financial cost over the relevant financial gain may be carried forward and deducted from the relevant financial gain of the subsequent what? 5 years. So you see that to determine the chargeable income from the separate mineral operation, the excess relevant financial cost of what? 220,000 reckoned in arriving at the profit of the separate mineral operation should be what? Added back. Should be added back. And that is it. So you see that this is a profit for 2 million. The financial cost was 420,000, which was deducted in arriving at this profit. The allowable financial cost will only be to the extent of the financial gain. So it will be 200,000. So the excess of the financial cost of 220 will be added back. So when you add 220 to the 2 million, you'll be getting 2.220. And this excess, you tell the examiner that the excess financial cost can be carried forward for a period of what? 5 years to be able to charge it against a subsequent financial gain, if any. So what they are saying is that the financial cost can only be allowed in a financial statement or in arriving at the chargeable income to the extent to which financial gain exists. If no financial gain, no financial cost can be allowed in the financial statement. This point is very, very important. This is how we treat financial costs and financial gain. Please, it's always important for students to look at that area. Now, withholding tax issues, again, on the mineral operation. A company that conducts a mineral operation shall withhold tax under the relevant section of the Act. The company that conducts mineral operation shall withhold tax at the rate of what? 3%. When the person pays for the what? The unprocessed what? Precious minerals located in the country or won from the country. So anytime they supply you the minerals and you are paying for it, please you make sure you hold a tax of what? 3% before you give the net amount of 97% to the person. And this does not apply to payments made by individuals. When it's a payment made by individual, this withholding tax does not apply. Payment made by the holder of what? A small-scale mining license to a laborer with respect to winnings from the area covered by the license. It does also not apply. And then payments received by the holder of a large-scale mining license. A resident company or a resident company that is a partner in a partnership that conducts or has conducted mineral operation shall withhold tax on payment of dividend to resident or non-resident company regardless of a percentage of control. So when it comes to the withholding tax on dividend, please, you are required to withhold a tax of 8% before you pay the net amount to the person. So where persons have controlling interest in the company and the company has declared dividend, regardless of the control, whether they acquire 60%, 70%, 30%, 10%, please, you are withhold a tax of what? You have to withhold a tax of 8% on the dividend and pay the net amount to the person. So that's withholding tax on dividend. But when it comes to the gold, please, in making payment, you withhold a tax of what? 3% on the precious minerals. Okay. So these are terminologies. What the meaning of large-scale mining? Large-scale mining lease means a mining lease that is not subject of a small-scale mining lease. You see, when you are defining things, you see, in tax, you just say what the law says and then you are free. The law says that a large-scale mining lease means a mining lease that is not the subject of a small-scale mining lease. That's all. Small-scale mining has a meaning given in the Minerals and Mining Act. Means a small-scale mining license granted under Section 82 of the Minerals and Mining Act. That's the meaning of definition of what? A small-scale mining lease. The small-scale mining lease means a small-scale mining lease granted under Section 82 of the Minerals and Mining Act. Then, unprocessed precious mineral means unprocessed gold and rough diamonds within a meaning given in the Minerals and Mining Act of 2006 at 703. And other minerals as may be prescribed by regulations. So when you say unprocessed precious mineral, it means unprocessed gold and rough diamonds within the meaning given in the Minerals and Mining Act of 2006 Act, and other minerals as may be prescribed by the regulation. Okay. The meaning of reconnaissance and prospecting operations. This section applies to reconnaissance and prospecting operations conducted by a person as part of a separate mineral operation before the commencement of the production of a commercial find. You know, I told you that before you start producing in commercial quantity, you first have to do what we call reconnaissance. Reconnaissance, I told you, is searching for the minerals. Prospecting is now developing them to see whether the things are there in commercial quantity. Then you are doing prospecting. Okay, that's more of development. So what they are saying is that these things are normally done to be able to determine whether production can commence in commercial quantity. A person who incurs a revenue expenditure or a capital expenditure in the course of reconnaissance or prospecting operations shall place the expenditure in a single pool. Okay. So which means that it can become a capital allowance expenditure. So any expenditure, a person who incurs what? A revenue expenditure or even a capital expenditure. But it is only not done in when actual production is taking place, but it was done in the course of what? Reconnaissance. The revenue expenditure was incurred in the course of reconnaissance, or the capital expenditure was incurred in the course of reconnaissance, or in the course of prospecting, non-actual production, searching for the minerals and development of the minerals. In that case, that revenue expenditure or capital expenditure shall be placed in a single word pool, and a deduction or capital allowance shall not be granted by the Commissioner General with respect to the expenditure. So when it happens like this, deduction or capital allowance shall not be what? Granted. Deduction means that allowable expenditure. Or if it's a capital expenditure, you don't calculate capital allowance on it. It shall not be granted. Why? Because you are only in the what? You are only in the reconnaissance, and you are also only in the what? Prospecting phase of production. That is why a deduction or a capital allowance shall not be granted by the Commissioner General with respect to the expenditure. The expenditure shall not form part of the cost of an asset. You see, at that point, the expenditure shall not form part of the cost of an asset. Very, very important. So please, this session applies to reconnaissance and prospecting operations conducted by a person as part of what? A separate mineral operation. Before the commencement, please, the key word there is what? Before the commencement of production of a commercial find. If this is done before the commencement, if the expenditure is incurred before the commencement of production of a commercial find, then where the person incurs a revenue expenditure or a capital expenditure in the course of the reconnaissance or prospecting operation, all you need to do is you shall put it in a single pool. But a deduction or capital allowance shall not be granted by the Commissioner General with respect to the expenditure. And you can also, the expenditure shall also not form part of the cost of an asset. Cannot form part of the cost of an asset. Now, an expenditure shall not be included in the pool. When it comes to the expenditure being put in the pool, an expenditure shall not be included in the pool if the expenditure is a domestic or excluded expenditure. Yes, domestic expenditures are expenditures incurred for private purposes. So you cannot put that one in a pool. Okay, so when being asked about expenditure to be excluded in a pool, please, the first one is what? Domestic or excluded expenditure. Number two, if it fails to meet the requirement of Section 81, and Section 81, that is expenditure in respect of what? Our research and what? Development in the acquisition or improvement of a valuable asset if it does not meet the deductibility test. Okay. So it means that if the expenditure in respect of research and development was not incurred wholly, exclusively, and necessarily for the purpose of the mineral operation, then you cannot include it as part of the expenditure. It must meet what we call the deductibility test. And the deductibility test refers to expenditure incurred wholly, exclusively, and necessarily for the purpose of production. Once it does not meet that, you cannot include it as part of the expenditure in the pool. Okay. So that's for the reconnaissance and the prospecting license. Any expenditure incurred before production in commercial find, the law is saying that we should just put it in a separate pool. We are only waiting for when production will commence, okay, before you start charging them. Okay. Now, income. What constitutes income from mineral operation? What constitutes income from mineral operation? Just as we were discussing what constitutes income from petroleum operations, students they must also be conversant with what constitutes income from mineral operation. The following constitutes income from mineral operation. Number one, or A, an amount derived or treated in Section 31 as derived from what? From the disposal of what? Minerals obtained from the lease or license area during the year. So this is a sales revenue. The first one is the sales what? Revenue. That's an amount derived from the disposal. You see, disposal is sale. disposal of what? It can be an exchange or sale or whatever. Of the mineral what? Obtained. How much have you derived from the disposal of the mineral obtained from the lease or the license area during the year? That's the first item that constitutes income from what? Mineral operation. B, compensation derived, whether under a policy of insurance or otherwise, in respect of what? Loss or destruction of the minerals from the lease or the license area. So when we're learning this, the same thing we learn under petroleum operation. Okay? Where you are getting a compensation, you have insured the mining area or the license area, you have insured it in respect of loss or destruction, and you are getting a compensation. You see, then what they are saying, that compensation that you are deriving in respect of the loss or destruction of the minerals from the lease or the license area will constitute an income from the mineral operation. C, an amount derived in respect of the sale of information pertaining to the mineral operations or the mineral reserves. You see, so where you have the expertise and you are the company is selling that expertise by way of proprietary knowledge and all that in relation to the mineral operations or mineral reserve, that sale amount derived in respect of the sale of the information pertaining to the mineral operations or mineral reserve constitutes an income from the mineral operation. 4, again from the assignment or the disposal of one interest. You know, the company can decide to assign its interest or dispose of its interest to another person. Any gain from the assignment or the disposal of an interest in the mineral mining rights with respect to the operation constitutes an income from the mining operation. So you have a mining right and you decide to assign or dispose of that right. It can be 100%, it can be 80%, it can be 70%, it can be 60%, 30%, whatever. So when you assign the right, it's like you are disposing of the right. Remember, you acquire the right at a cost. So in disposing of, you get a consideration for that. So when the consideration is more than the cost incurred in acquiring that right, then there will be a gain from the assignment. In that case, it constitutes an income from mineral operation. Then any surplus, number 5, a surplus in an approved rehabilitation fund. Just like we're doing the petroleum operation, we mentioned decommissioning fund. And the mineral operation, we mentioned rehabilitation fund. You know, normally the mining area, after you have finished looking at the cycle, okay, always the cycle will tell you that you do reconnaissance, you prospect, prospecting will come, okay, you obtain the license, you do the mining, and then now, after production, if the operation is fully completed, you have to do rehabilitation. Rehabilitation means you are bringing the place back to its state. You don't just spoil the place and leave it. And I told you that normally the law requires that a surplus is built towards rehabilitating the place. In petroleum, we call it decommission fund. But in mining, we call it rehabilitation fund. So, if at the end of the operations and you have rehabilitated a place and still there's a surplus left in the fund that you have built for the purpose of the rehabilitation, that is what they refer to as a surplus in an approved rehabilitation fund. So the surplus here therefore constitutes an income from the mineral operation. So here please the word is surplus in an approved rehabilitation fund. And then lastly, any other amount derived by the person during the year from or incidental to the operations that is included in calculating the income under other provisions of the Act. So these are other incomes. It can even be by way of investment incomes, provided they are also included in computing income under other provisions of the Act. They also constitute income from the mineral operation. So please, any other amount derived by the person during the year from or incidental to the operations that is included in calculating income under other provisions of the Act, they also constitute income from the mineral operation. Please, this can come by way of theory or you can apply it by way of calculation. Very important to know what is the meaning of what? Income from what? Mineral operations. Section 80 of the Income Tax Act of 2015. Now, what are the deductions for mineral operations? Just like we learned deductions from petroleum operations, Section 81 of the Act, 896. The following constitutes deductible expenditure so far as the mineral operations are concerned. Number one, ground rent. Ground rent. In a petroleum operation, we're talking about rental charges. But they say ground rent. You see, the ground, the area where you are extracting the oil, the minerals. Okay, it is rented. That land where the mineral is being extracted, that land is not only rented. Okay, and the rent you pay is called a ground rent, and it's a deductible expense for the company that is paying the rent, especially to government. And then the royalties. You see, royalties paid. Royalty is an amount payable for the use of the right to win the minerals. Okay, on the land, the royalty. So, the amount you are paying to win the mineral, which is called the royalty, is a deductible expense. It's a deductible expenditure. So, you pay to government as revenue, but you, the company that is paying, you can allow it as, the taxman will allow it as what? An allowable expenditure. So, I'll do this one too. Ground rent one, royalty paid by the person under the Minerals and Mining Act is also 2. Then I'll make this one capital allowance. Though the law says A and A, they've mentioned what? Ground rent and what? Royalties. Then capital allowances, that are granted, they are also deductible allowances. And they are normally calculated in accordance with Part 3 of the third schedule. If you want to know how to calculate it, like we explained the last time for petroleum, I'll recap that for mining for you. That capital allowance that is granted is also an allowable expenditure. Then the approved rehabilitation fund. I told that the government requires that companies engaged in a mining operation should always have a rehabilitation fund which must be approved. How do you generate money into the fund? Unless you contribute. So contributions to and other expenses incurred in respect of an approved rehabilitation fund is an allowable expenditure. So any contribution, any amount that is being paid into the fund. So for the year that you are making that contribution, please, it can be charged as an expense in the accounts. Please, when you understand these things and it comes by way of calculation, it becomes very easy as well. So though, in theory, you must learn this, but please, this is what will help you in your calculation. Please, any contribution or expenses that are incurred in respect of an approved rehabilitation fund for the mineral operation is an allowable deduction. Then number 4, which I will say 5, expenses incurred by the person in the course of reclamation or rehabilitation and closure of the mineral operation, where the funds in the relevant approved rehabilitation fund are not yet available or are inadequate. So, for example, remember that you are contributing into the fund and it's being allowed as an allowable expenditure in the year that you are making the contribution. Now, the fund has been created and now you have finished the mining operation and you are supposed to rehabilitate. What they are saying is that where there is a fund and the amount of expenditure for rehabilitation is more than the fund set up for the rehabilitation, the excess is an allowable expenditure. For example, the fund set is 1 million, but you have incurred 1.2. The 200,000 will become an allowable expenditure. Because the fund itself, the contributions I am making to the fund is a C. So the D is only talking about where the rehabilitation has been done, and the expenditure for the rehabilitation is more than the amount in the approved rehabilitation fund. The excess becomes an allowable expenditure. But where you don't have the fund at all, and you are now incurring the expense to rehabilitate the place, then that expenses that you are incurring towards the rehabilitation will become an allowable expenditure. And lastly, any other expenses incurred by the person during the year for the purpose of mining operation, that may be deducted. So this is the point. That may be deducted under other provisions of the Act. So here, this applies to all expenses which are allowed and other businesses as well. You see, so salaries and wages, donations towards welfare courses, bad debts, all those things, interest. These are expenses which are normally allowed, you see, for other businesses. And those expenses will also be allowed for what? Mining companies as well. So that's all for deductions under minerals what? Operation. Okay. So, in ascertaining the income of a person from a separate mineral operation for a year of assessment, the relevant financial cost incurred during the year may be deducted only to the extent of the relevant financial gain. So this another, the relevant financial cost, like we said, can be deducted only to the extent of the financial gain. A person may set off a loss. So even in respect of financial instrument, against the gain in respect of the financial instrument only. You can only set off what? A loss in respect of financial instrument against a gain in respect of financial. A person may set off a loss in respect of a financial instrument. That's called the financial cost. Against a gain in respect of the financial instrument only. So you can only charge a financial cost against a financial gain only. A financial cost for which a deduction is not available may be carried forward and treated as incurred during any of the subsequent 5 years of assessment. So let's say in a question, the business or the mining company incurred a financial cost of 1 million, but have not got any financial gain. Remember, they have charged the 1 million to arrive at their profit. But in that year, there was no financial gain. What it means is that in trying to determine the chargeable income for tax purposes, you have to add back all the 1 million. The reason being that there was no financial gain which will be used to absorb the financial costs in the accounts. And that 1 million can be carried forward for a period of what? 5 years. Following a year, if the loss was what? The financial cost was what? Incurred. Waiting for a financial gain to be able to absorb it. Very important. That's why they are saying that a person may set off a loss in respect of financial instrument against a gain in respect of financial instrument only. Which means that if no financial gain, no financial cost can be allowed. If no financial gain, no financial cost can be allowed. The extent of financial cost that will be allowed will be to the extent of the financial gain. Very, very important point. Okay? So anytime there is a financial cost, always look out for financial gain. If there's no financial gain and the financial cost has been charged in arriving at the profit, please add back the financial cost. We mentioned that already. Now, where a person carrying forward a financial cost, the cost can be deducted by the person from the income of that person in the order in which the cost was what incurred. So here, whenever you are writing on base, you must also say that it must be on FIFO basis. That's the first in, first out basis. In other words, the first financial cost that comes, you have to absorb that one with a subsequent financial gain. And then any new financial cost that will be incurred will also follow, and each of them have 5 years following to be able to generate a financial gain to absorb that financial cost. So anytime you're writing, say that it must be on first in, first out basis because it is time bound. For the purpose of granting capital allowance, the cost of depreciable asset with respect to separate mineral operation includes the cost of the mineral right. Okay, now if you are looking for figures to grant your capital allowance, the mineral right is a capital allowance expenditure. The balance in the pool of reconnaissance and the prospecting expenditure at the time of commencement. So this was the one that we were saying that you put it in a pool, waiting for production of commercial quantities. So at that time, any balance on the reconnaissance and prospecting expenditure at the time of the commencement of production will become a capital allowance expenditure. Okay. Expenditure incurred in respect of what? The mineral operations on waste removal, overburdening, stripping, shaft sinking, and other activities. That is capitalized in accordance with the generally accepted accounting principle and does not otherwise qualify to be included in the cost of an asset. Can also be included. Very important. And then bonus payment in respect of what? The grant of what? The mineral rights. All these are expenditure which can be allowed for purpose of what? Inclusion for capital allowance purposes. So, please, when asked for the purpose of granting capital allowance, the cost of what? Depreciable asset with respect to the separate mineral operation includes the following. But it is not exhaustive. But it includes the cost of the mineral rights, the balance in the pool of reconnaissance and prospecting expenditure at the time of commencement of production of a commercial find. Number 3, expenditure incurred in respect of what? Mineral operations on what? Waste removal, overburden, striping, shaft sinking, and other activities that is capitalized in accordance with what? Generally accepted accounting principles, and does not otherwise qualify to be included in the cost of an asset. Once it's included in the cost of an asset, you don't come and include it again over here. And then bonus payments in respect of what? The grant of what? A mining what? Right. The grant of a mining right. Okay. But remember that apart from these, if you have forgotten these, all those fixed assets which are acquired for purpose of mining, like what? Machines, equipment, and all that, okay? They are all can be cost of a depreciable assets. Okay, so other fixed assets, you are aware of them already. That's why the tangible fixed assets. Yes, once they are incurred for the purpose of the mining, they can also be cost of a depreciable asset with respect to the separate mining operation. Now, when it comes to losses, let's say in a particular year, the company has made a loss. How are losses treated? Because mining companies like petroleum operations are businesses in the priority sector of the economy, losses incurred in a particular year under a separate mineral operation can be carried forward for a period of what? 5 years following the year in which the loss was what? Incurred. And it must be on first in, first out what? Basis. So losses incurred itself is an allowable expenditure for a period of what? 5 years following the year in which the loss was incurred, to be charged against what? Subsequent profit for that year. If after 5 years, the business could not generate sufficient profit to absorb the loss, in other words, the business could not get its chargeable income to absorb the loss can no longer be carried forward. Remember, losses that cannot be absorbed in a particular year are called unrelieved losses. And the losses that were able to be absorbed is called relieved losses. Okay. So whenever there is a loss, you need to find out whether that loss can be relieved in subsequent 5 years following the year in which the loss was incurred. If after 5 years following the year in which the loss was incurred, there was no sufficient profit to absorb or relieve that loss, then that loss can no longer be carried forward. And it must always be on first in, first out basis. It must be on first in, first out basis. Very important. Because the losses are time bound. So the first loss that comes has 5 years following the year, followed by the next loss that comes will also have 5 years following the year it was incurred. Unrelieved loss of a person from a separate mineral operation. The person shall deduct the unrelieved loss in order in which the losses are incurred. And the losses from the separate mineral operation may be deducted only in calculating future income from that operation and not income from any other activity. So please don't go and charge a loss from a separate mineral operation against an income from another activity. No, please, it should be in respect of the same separate mineral operation. This point is also very important to make. Okay. Where a person holds a direct or indirect interest in an entity that holds a mining right, the person is treated as holding the interest as a capital asset employed in the business of that entity. Okay. So that interest that you have, you see, the holding, the entity that holds the mineral right, the person is treated as holding the interest as a capital asset employed in the business of that entity. Okay. Where the underlying ownership of an entity that holds the mineral right changes by what? 5% or more, the entity is considered to have disposed of. So this is what we call direct and indirect assignment. The entity is considered to have disposed of what? A proportionate interest in its mineral right, and immediately reacquire that interest by incurring an expenditure that is equal to the amount derived for the right disposal. So if the change is only by 5% or more, the entity is considered to have what? disposed of a proportionate right in its mining rights and immediately reacquired that interest by incurring an expenditure that's equal to the amount they received for the right disposal. And they received for the disposal consideration to equal to the amount received or receivable as consideration arising out of the change in what? Ownership. Now, the market value of the proportion of the right treated as disposed of, whichever is what? Higher. So here we are saying that when it comes to the consideration to consider, it is either the market value of the amount that you have received, whichever is higher will be the consideration. So consideration is always equal to the amount received or receivable as consideration arising out of the change in ownership, or the market value of the proportion of the right treated as disposed of, whichever is high. So when it comes to consideration, anytime that there's disposal of interest, the question is, what is the consideration? And they say the consideration can either be what? How much you have received or how much you are going to receive, and compare it to the market value. Whichever is higher will be the consideration when it comes to disposal of interest. Okay. Where the ownership of an entity changes in a manner referred to, that's 5% or more, the entity shall notify the Commissioner General within what? 30 days from the date of the change. So the moment you have the interest in the company has changed in terms of the holding, please, you are supposed to inform the Commissioner General within what? 30 days from the date of what? The change. An entity that fails to comply commits an offense and is liable on a summary conviction to a fine of not more than what? 200 penalty units for each failure. A penalty unit is 12 Ghana cedis. So, an entity, if you fail to inform the Commissioner General within what? 30 days, you are liable on a summary conviction to a fine of not more than what? 200 what? Penalty unit. That 200 times 12. This section does not affect the tax return of actual disposal of mineral rights. And then the application of section 62 to an entity that holds a mineral right. Does not affect it. An amount accumulated in or withdrawn from an approved rehabilitation fund by a person who holds a mineral right for the purpose of rehabilitation of the area, which is the subject of the mineral lease, is what? Normally exempt from what? Tax. So any amount accumulated or withdrawn from an approved rehabilitation fund for the purpose of what? Rehabilitation, please, is exempt from tax. So though it's an income, because it is toward the rehabilitation, it's exempt from what? Taxation. Now, where there is a surplus in the approved rehabilitation fund, after a person completes the rehabilitation of a separate mineral operation conducted by the person, at the time of the person breaches or an approved rehabilitation plan, the surplus shall be included in calculating the income of the person from the separate mineral operation for that year of what? Assessment. So we've said that any surplus in the rehabilitation fund is considered as part of what? Income for the year. Okay. So now let me take you through the treatment of capital allowances under mineral operation. I want to say that it doesn't change from petroleum. It's the same way that we do for petroleum. That's the same way we treat capital allowances under our mineral operation. The only difference between capital allowances under mineral operation and capital allowances, treatment of capital allowances under mining operation is that when there is a disposal of a depreciable asset in the pool, okay, that disposal is always subtracted from the written down value of the pool. And the balance left is what we calculate the capital allowance on, depending upon what? The remaining useful life. I repeat. The calculation of capital allowance under what? Under petroleum operation does not differ from the way it is calculated under what? Mineral operation. So the principles that we learned under petroleum operation still holds for what? Mining and mineral operations. The only difference between the two is when it comes to disposal of what? Depreciable. And that's the point number 2 here. This one. This is the only thing that point number 3. This is the only thing that differentiates calculation of what? Capital allowance under mineral operations from capital allowance under what? Mining what? Operations. Proceeds from the disposal, point number 3. Proceeds from the disposal of the asset in the pool is subtracted, because under petroleum, the whole proceeds will be added as part of the income, which means that there will be nothing that will be subtracted from the written down value of the pool. No. But for mining, you must subtract the proceeds from the written down value of the pool. Unless the proceeds is more than the written down value of the pool, then the excess, that's number 5, the excess of consideration received over the written down value of the asset is added to what? Income. Under petroleum, it is not the excess, it is the whole process which is added to income and tax using the 35%. But under mining, please, you must first subtract the proceeds from the written down value of the pool. It is only when the proceeds is more than the written down value of the pool that the excess of the consideration received will be added to the assessable income and tax using the corporate tax rate. That's the only difference. Apart from that, that's all. So it means that under mining operations, number 1, the first is to establish the capital allowance expenditure to be placed in a separate pool. So we mentioned some that are before production, actual production, like reconnaissance license, prospecting license, the mining rights. These are all pre-production costs. Okay? You put them in a pool. Then you have actual fixed assets, like especially when you start the commercial production, plant and machinery, mining equipment, motor vehicles, computers. You see? So in a year of acquisition, you put them into another separate pool. And then what do? You grant capital allowance on it at a rate of what? 20%, which is 5 years on straight line basis. Every year. So the first year, you say, I told you divide by 5. The second year, you divide by what? 4. Third year, you divide by 3. Fourth year, you divide the written down value by what? 2. And then last year, you divide the written down value by 1. That's how we calculate the capital. Very, very simple. You don't put them into class 1, class 2, class 3. No. For mining and petroleum operations, all you need to do is to, first of all, determine the capital allowance expenditure you are concerned with. Okay? Determine that capital allowance expenditure. Okay? And put them into the pool and begin to grant capital allowance. Depending upon the year of acquisition, then it will start from divided by 5. But if, for example, you are in the 3rd year already, which means that you are left only in the 3rd year, if you are at the beginning of the year, you divide that one by 3. Because if you are left with 3 years, divide by 3. If you are left with 2 years, divide by 2. If you are left with 1 year, divided by 1. If you are left with 4 years, divide by 4. That's all. This is how we calculate capital allowance under mining and mineral operation. So anytime there's a question on capital allowance under mining and mineral operation, it should be a bonus question for you. What's important is to, first of all, determine the capital allowance expenditure. In other words, the qualifying capital expenditure on which you are going to grant the capital allowance. Once you are able to get the cost, you divide it by 5. Second year of that will be by 2. 4. Third year by 3. Fourth year by 2. And then the 5th year by what? 1. At the end of the 5th year, please, the balance should read 0. The remaining balance should be 0. No balance should go beyond 5 years, as far as capital allowance expenditure is concerned. So, acquisitions made in subsequent years must be placed in separate pools. You see. So, for example, let's say in year 1, you made some acquisitions. So, those ones have 5 years to go in year 1. So, you divide by 5. Then in year 2, there is a written down value for a particular pool, which you started in year 1. But in year 2, you have done some new acquisitions. What it means that in year 2, those ones will also become costs. So you divide that one by 5. So though you are in year 2, that one will be divided by 5 because that was its initial year of what? Acquisition. Okay. It is the written down value. Whenever you are given a written down value, you have to know the remaining useful life and divide it by that number of useful life. That's all. But in the year of acquisition here, it should be divided by what? 5. That's all. Additional capital allowance shall be granted if the original value of the asset exceeds the what? Consideration received for the what? For the disposal. So where all assets in the pool has been realized, okay, and yet the consideration received is less than the written down value of the pool, then the remaining figure will be given to you as well, an additional capital allowance. I repeat, where all assets in the pool has been realized, yet the consideration received is less than the written, and under normal circumstances, the written down value, what is left, you have to divide it by the remaining useful life. But in this particular scenario, all assets in the pool has been realized. So there's nothing to carry forward again. Then in that case, whatever figure is left, because the original value is more than the consideration, the whole figure will be granted as well, an additional capital allowance. That's number 6. 7. Where an asset is partly used in separate mineral operation, capital allowance shall be apportioned by what? The Commissioner General. You understand? So the extent to which you are using the asset in the separate mineral operation, if the asset is being used to the extent of 60% in mineral operation A and to the extent of 40% in a mineral operation B, then it means that capital allowance must be apportioned by the Commissioner General to the extent to which the asset is being used in the separate mineral operation. But please, when it comes to the computation of capital allowances are computed for each separate mineral operation. So far, even though the company be the same company, if the locations are different and they are not sharing the processing facility, the capital allowance will be calculated separately for them, unless they are sharing the same processing facility. Now, where a person assigns a mineral right to another person, like we said in the petrol operation, the original value of any capital allowance expenditure is transferred to the assignee at the beginning of the year. So, for example, in capital allowance computation in year 3, the company decides to assign 40% of its rights to another company B. What it means is that the original values that you have in year 3, you divide and find 40% of that for the assignee, because you are giving 40% to a new person, and then you retain the remaining one, 60%, so far as all the original values of the asset. So whenever there is an assignment of interest and you are calculating capital allowance, the original values that are left over there, please, you just apportion it to the extent of the percentage of interest assigned. So if A has assigned 40% to B, then A will now retain 60% of all the original values, and then B will take over 40% of all the original values, and everybody will continue calculating his or her capital allowance the normal way. Okay, that's good. Then, capital allowance expenditure that enjoys capital allowance shall not be granted capital allowance in respect of other activities of the person. See, so you don't grant capital allowance on an expenditure, and then you go and grant capital allowance again in respect of the same expenditure in respect of the other activities of the person. No, it must be restricted specifically to the particular activity for which the capital allowance is being granted. You restrict it to only that. That's all. So these are the principles regarding capital allowance when it comes to mining operations. Very, very simple. Ganisonge Limited illustration. Ganisonge Limited is a mining company at Nangodi in the Upper East region. It commenced operations in 2018 and incurred the following costs from inception. Reconnaissance cost was 120 million and prospecting cost was 140 million. And they started production in 2018. The following assets were acquired in December 2016. Okay, so these assets which were acquired even before production commenced. The fact that the assets were acquired before production commenced does not mean that when you start production, you don't grant capital allowance. You still grant capital allowance in the year of commencement of production. Computers, plant and machinery, furniture, and fittings, building required. Compute the capital allowance for the 2018 year of assessment. So now you look at these ones. These ones are expenditure normally incurred before production. Reconnaissance costs, prospecting costs. This is a search for the mineral, and this is the development of the mineral, the prospecting. Okay, so when you put the two, these are, we call them pre-production costs, costs before production. 140 plus 120 will give you 260. Then this one, when these were acquired also before production, but they are tangible assets. So we want to separate the tangible ones from what? The intangible. Okay, we want to separate the tangible ones from the intangible. So you look at the headings. Ghanaian Songhai Limited proposed computer allowance of what? For the year 2018. So this is a year of assessment. Okay. And this is a basis period, January to December. But it depends upon the particular company in question. So these were the costs before production, which were intangible. And that was 260. Then the rest, the other assets, which are tangible assets, because they were acquired in the same year, we put all together over here and we get 1.9. Now, because this is your first year of computation, you divide this figure by 5. And when you get the figure by 5, you get a capital allowance, that's all. And then you get a total capital allowance for the year. Then this will be the written down value. And this is a value that I said that when you go to the second year, you have to divide it by 4. Divide it also by 4. Then you get the total capital allowance. Third year, you divide it by what? 3. You divide it by 3. And then you get your total capital allowance. So capital allowance is very simple. What is important is how to get the total cost that you are going to build up to start the computation. And in this case, what we did was that the intangible ones, we put them together. And then we also put the tangible ones together. Now let's assume that in the course of year 2, you happen to acquire a new asset. Then there will be another other asset again. Because this, you cannot go and add it to the written down values here. Because these ones have 4 more years to go in the second year. So in the second year, when new assets are acquired, they will have 5 more years to go. So you put another column and say other assets and divide that one by 5. While the written down values that you have brought forward from the previous year will be divided by what? 4. That's how we compute capital allowance. Very interesting and very simple. Okay. Note, the reconnaissance and prospecting costs called the pre-production are pooled separately. The other assets are put together and capital allowance as they relate to the same period. There are no separate classes of assets as we had under the repealed Act 2000. In the former Act 2000, that's the IRS Act, you have to find the class they belong. No. But under the new Act, you don't need to find the classes that they belong before you calculate capital allowance. That's why computation of capital allowance under the new Act is very, very simple for mining and petroleum operations. Okay, so this one is a sample question for practice. It's a sample question for practice, and I indulge all students to practice it for discussion. And those of you who do it, for the email that we provided, you can email them or send them personally if you want, or to the school, and we'll mark it for our discussion. That's for the capital allowance. Now we are looking at the tax incentives for mining companies. Okay, mining companies enjoy some tax incentives. Okay, so let's quickly look at the number 1. Exemption from the payment of what? Customs duties on plant and machinery, parts, equipment, etc. So when it comes to the, these ones are more theoretical. When it comes to you being asked some tax incentives enjoyed by mining companies, one of the things you can say is that when it comes to the payment of customs duties on their plants and machinery, as well as the parts and equipment, okay, they are normally exempted from customs duties. 2, they are normally given permission to retain at least 25% of their foreign exchange earnings in an external account for the purpose of acquiring the plants, the machines, the equipment, the spares, etc. So they are allowed to retain at least 25% of their foreign exchange earnings in in an external account. Most of the times, these gold and diamonds, they are all sold outside. Okay, so they can maintain 25% of their earnings in an external account. But the purpose is for to acquire plants, machines, equipment, and spares. 3, partial or deferment of their stamp duties and registration fees for 5 years from the date of commencement. So when it comes to stamp duties, stamp duties give legal effect to documents. Okay? And when it comes to payment, they can defer it partially or fully. Okay? For a period of what? 5 years from the date of commencement. Then mining companies are giving immigration and personal remittance quota in respect of what? Expatriate staff. When it comes to mining companies, even petroleum companies as well, they are expatriates that want to come and work here. They can come without work permit, but there is a quota that they can give them. Not all of them, no. So, but it's an incentive to encourage them to come. So, immigration and personal remittance quota in respect of what? Expatriate staff. So here, they don't even require, once it is within the quota, they don't require a work permit. The ability to carry forward losses for a period of what? 5 years, following the year in which the loss was incurred, is also an incentive to them. And when you are doing employment income, any accommodation that is given to an employee with the mines who is residing at the site where the mining activity is taking place, the accommodation benefit is exempt from tax. So the employee will not pay an accommodation benefit when it comes to what? Employees who are living on the what? On the mine site. Very important point. And then the fact that they can capitalize their reconnaissance, and for that matter, grant a capital allowance on it, which will go a long way to reduce their profit, will also be an incentive to them. So these are some incentives to what? Mining companies. Okay, thank you. Now, when it comes to mineral royalties under the Mining and Mineral Act, how is it calculated? Now, a royalty, like I said, is an amount payable for the use of what? A right. So if the government has given the person the right to mine the minerals, the person must pay the government a royalty for giving that right to you to mine. Okay. Now, there are a whole lot of controversies. Now we want to go and invest our royalty in tax havens and all that. Okay. Now, every holder of a mining lease shall be liable to pay a royalty in respect of its mineral operations to the Republic of Ghana, please, at a fixed rate of what? 5% on the value of the mineral won, being the total revenue earned from the minerals obtained by the holder. Government is entitled to 5%. It's a flat rate. So when you are treating a particular mining question and you are asked to calculate the royalty, if the examiner does not give you the rate, don't go and say, where is the rate? Please, the rate is 5%. The value of what? Mineral won, or the revenue, or turnover. That's how we calculate. Very simple. Okay, so every holder of a mining license having produced the mineral, so this one is on revenue. In petroleum, we say we normally use the quantity, but for minerals, they use the revenue. Okay, so 5% on the value of what? Mineral won, being the total revenue earned from the minerals obtained by the what? Holder. Okay, so it's always a bonus question when asked to calculate what? The mineral royalty, which is an allowable expenditure to the person who is paying. We learned it. But it is calculated what? 5% of the value of the mineral won. Operational costs. In mineral operation, when we say operational costs, they are operational costs. Operational costs is the expenditure wholly and exclusively incurred in any period for the purpose of mining, transporting, processing, or sales of the mineral won, including what? Capital allowance. So look at it. How many? 1, 2, 3, 4, and then 5. All these 5. Now what we are saying is that under mining operation, what's the meaning of operational cost? Their operational cost is the expenditure wholly. Wholly means the quantum of the amount. Exclusively means the expenditure must have relevance, okay, to to the business. That's exclusively. It should be relevant to the business. And so the expenditure wholly and exclusively incurred in any period for the purpose of what? Mining, transporting, processing, or sales of the mineral one, including what? Capital allowance. So if you want to get operational costs right, what you need to find out from yourself is that, was the expenditure incurred wholly and exclusively, number one, for the purpose of what? Mining. Once you are able to establish the fact that the expenditure was incurred for the purpose of the mining, please, it's part of their operational costs. So even if, for example, they go and take a loan, and they are paying, the loan is meant for mining, and they are therefore paying interest on that loan, please, the interest on the loan is part of the operational costs. Why? Because it is for the purpose of what? The mining. Take note of that. If the expenditure is for the purpose of transporting the mineral one, please, it's part of the operational cost. If the expenditure is for the purpose of processing, normally when they extract the raw gold, they process it. Okay? Any expenditure incurred for the purpose of processing the mineral one is part of the operational cost. Or assuming they want to sell the mineral that they have won, the selling expenses towards the sale of the mineral one is part of the operational cost. Because they say the expenditure incurred wholly and exclusively for the purpose of what? Mining, transporting, processing, or sales of the what? Mineral one. And they say it includes what? Capital allowance for the year. So whatever capital allowance that you have incurred for that year, please, is part of what? The operational cost. Very, very important. It, however, excludes the royalty payable. You see, the royalty there is an amount payable for the use of the right. It is not for the purpose of the mining, it's not for the purpose of the transporting, it's not for the purpose of processing or the sales of the mineral one. So royalty payable, it is not an operational cost. Though it's an allowable expense, but it is not an operational cost. Income taxes are also not operational costs, and income taxes are also not allowable expenses. Or any payment that must be made under an agreement between the government and the person on the value of or receipt from the mineral one under any agreement, or in the case of a company, any expenses in the management and control which in the opinion of the Commissioner General are not directly related to the operations of mining, transporting, processing, and sales of the mineral one, they are not part of operational costs. So if under the agreement you are supposed to pay government something, okay, please, it is not for the purpose of the mining, transporting. So that payment you are making under the agreement is not part of the operational cost. Unless you are able to establish that the expenditure was incurred for the purpose of what? The mining, transporting, processing, or sales of the mineral one, including capital allowance. Operating margin. An amino operating margin is the value of the mineral that they have won less the operational cost that you have established. The margin is like gross profit margin. Okay, so it's the value of the mineral one being the turnover less the what? The operational cost is called their operating what? Margin. Operating ratio. The ratio is a percentage or a proportion by which the operating margin bears to the value of the mineral one during the year. In other words, the operating margin divided by the turnover times 100 is called the operating ratio. Ratio is expressing an item in the financial statement to another. So, in terms of mining the mineral operation, when you say operating ratio, you are expressing the operating margin to the value of the mineral one being the turnover, and that's called the operating ratio. So, it can be 10%, 50%, 20% of the value of mineral one. This is the operating margin divided by the value of what? Mineral one. Okay, so that's all. Factors to be considered by the Mineral Commission before a license is recommended for issuance. Before the Mineral Commission will grant a license, okay, so what are those factors? Number one, you must have an evidence of the financial and technical resources at your disposal. In other words, at the disposal of the applicant. Whoever is applying for a mining license, before the Minerals Commission, this you see this under Section 11 of the Minerals and Mining Act. Okay, you must provide what? Evidence of what? Financial and technical resources at the disposal of the applicant. Number two. I should continue. Okay. So those are the factors to be considered in trying to add before a license will be granted to the applicant by the Minerals Commission. Okay, number one, you must give evidence of your financial and technical resources, which is at the disposal of the applicant. In other words, the applicant must give them evidence of their financial and technical resources. Number two, the applicant must give a proposed amount to be spent. How much do you hope to spend on the operations? You must, three, give them a program of your proposed mineral operations. And then the applicant's proposal with respect to our employment and training of nationals in the industry before the license will be granted. Okay. What is the meaning of stability agreement? At the Minerals and Mining Act, the meaning of stability agreement. This one came at the last two sittings. Okay. You know, the minister responsible for mines may, as part of a mining lease, enter into what? Stability agreement with the holder of what? A mining lease to ensure that, so this is what the stability agreement will ensure. To ensure that the holder will not, for the period of not exceeding 15 years from the date of the agreement, be adversely affected by a new enactment, a new order, a new instrument, or any other action made under a new enactment, or changes to an enactment, order, instrument that existed at the time of the stability agreement, or other action under these that have the effect or purport to have the effect of imposing obligations upon the holder or applicant of the mining lease, and be adversely affected by subsequent changes. So, at the time of the enactment, you will not be affected by any new enactment, and you will also not be adversely affected by subsequent changes to the level of payment of customs or other duties relating to the entry of materials, goods, equipment, and any other inputs necessary to the mining operations or projects. You will not be adversely affected by the level and payment of royalties, taxes, fees, and other fiscal imports. And you will not be adversely affected when it comes to laws relating to what? Exchange control, transfer of capital, dividend remittance. All they are saying is that it is just to give the person stability. That's how it works, stability agreement. So stability agreements are intended to cushion the investor, so far as the mining and mineral operation is concerned. So that even if there will be subsequent changes in enactments, laws, fiscal imports, taxes, royalties, fees, etc., that particular investor, being the mineral and mining investor, will not be adversely affected by any new enactments. Hence the word stability agreement. And normally they are entered into for a period of what? 15 years. Within that period, even if they increase the level of corporate taxes, that particular company will pay the same tax rate. It will not be affected by the increment in the corporate taxes. Stabilization agreement entered into shall be ratified by Parliament before it can take effect. So if Parliament does not ratify it, it will not take effect. Okay. So that's, in essence, mining companies want to be able to plan over a long period of time. But because they know it can be affected by changes in fiscal systems, they operate under. So they want to enter into such stability agreements to protect mining companies from fiscal changes. The mining companies enter into what? Stability agreement to ensure that any adverse fiscal system, be it levies, royalties, taxes, among others, does not affect the mining companies. Thus, the stability agreement allows said companies to benefit from any unfavorable fiscal system. That's all. That's the import of it. The stability agreement allows said companies to do what? To benefit from any favorable fiscal system. they will not be affected adversely if the fiscal system is unfavorable. Now, the meaning of development agreement. We've just looked at what? Stability agreement, and I want to look at what? Development what? Agreement. The Minister again of Mines, on the advice of the Minerals Commission, may enter into what? A development agreement under a mining lease with a person where the proposed investment by the person will exceed $500 million. So look at the key amount here. Development agreement. Okay? Where the Minister of Mines, on advice of the Minerals Commission, may enter into a development agreement under a mining lease with a person where the proposed investment by the person will exceed $500 million. A development agreement may contain provisions, so this is what it contains, relating to the mining rights or operations to be conducted under the mining lease. So it will spell out what? All the provisions that relate to the mining rights or operations to be conducted under the mining lease. Provisions relating to what? The circumstance or manner in which the minister will exercise a discretion conferred by or under this act. Provisions on stability terms will be enshrined in the development agreement. Provisions relating to what? Environmental issues and obligations of the holder to safeguard the environment in accordance with the act or any other enactment. Provisions when it comes to dealing with what? Settlement of what? Disputes. How disputes will be settled. They will all be contained in the development agreement. And note, a development agreement must also be ratified by Parliament before it can take effect. Before it can also take effect. That's all. That's about the development agreement. Okay. So these terminology, I think we've looked at them already. So it's always good to just go through what's the meaning of an approved rehabilitation fund. In respect of a mineral operation means a fund established as required under. These are interpretations in the Act. Okay, Section 85 of the Act. We give certain basic interpretations. The meaning of what? Approved rehabilitation fund means a fund which has been established under the law as required under any applicable mineral agreement or approved rehabilitation plan. Approved rehabilitation plan means a plan for reclamation, rehabilitation and closure of the operations approved by the minister responsible for mines. What's the meaning of mineral? We have been using the word mineral. Mineral means a substance. A substance in solid or liquid form that occurs naturally in the earth or on the earth or on the seabed or under the seabed, formed by or subject to geological process, including industrial minerals, but does not include petroleum as defined in the Petroleum Revenue Management Act of 2011, or it does also not include water. So when you say a mineral, like gold, diamond, bauxite and all that, it means it can be a substance. It can be in a solid form. It can also be in what? In a liquid form. But it must occur what? Naturally. Minerals must occur naturally. They can occur in the earth or on the earth. Some of the minerals can be on the seabed or under the seabed. And they are normally formed by what? Or subject to what? A geological what? Process. Including industrial minerals. But please, minerals does not include petroleum. It does also not include water. Petroleum and water are not minerals. The mineral right. Mineral operations means what? Reconnaissance. Anybody who is doing reconnaissance, who is doing prospecting, who is also doing mining for the minerals or the mining minerals, we are doing what we call mineral operations. So please, once you are searching for the mineral, you are doing mineral operation. Once you are developing the area to see whether it will be in commercial quantity. You are doing mineral operation. When actual production commences, now you are mining. Please, in all these, you are doing a mineral operation. The mining right means the reconnaissance license, the prospecting license, the mining lease, and a restricted mining lease. So mining right means what? Reconnaissance license, prospecting license, a mining lease, or a restricted mining lease. The mining area means an area designated from time to time by the holder of the mining lease with the approval of the Minerals Commission. So the mining area means an area. So the mining area is an area designated from time to time by the holder of the mining lease with the approval of the Minerals Commission. Okay. Then mining lease means the lease granted. The mining lease granted under Section 39 or Section 44 of the Minerals and Mining Act of 2006 at 703. So the mining lease means what? The mining lease granted under what? Section 39 or Section 44 of the Minerals and Mining Act of 2006 at 703. The mining lease area means the area covered by the mining lease. Okay. The mineral operations means the mining of minerals and the mining lease or agreement. It means an agreement concluded with government. The mineral agreement is the agreement concluded with government of Ghana in respect of a restricted mining lease. So those are the interpretations. Prospect means intentionally search. Prospecting. You see, prospecting means you are intentionally searching for the minerals, and it includes what? Reconnaissance and operations to determine the extent and the economic value of the mineral deposits. The prospecting area means the land subject to a prospecting license. The prospecting license means a prospecting license granted under Section 34 of the Minerals and Mining Act. And the reconnaissance means the search for what? The minerals, like I told you, by those geological, geophysical, photogeological surveys, and other remote sensing techniques, including surface geology in connection with it, including collection of necessary environmental data, but it doesn't include drilling or excavation. The moment you are doing drilling and excavation, you have gone beyond reconnaissance, searching for. The reconnaissance license means a reconnaissance license granted under Section 31 of the Minerals and Mining Act of 2006 at 703. So that brings us to the end, and then now let's look at some past questions. We are looking at, first of all, the ICA pilot question for the new syllabus. There was this question, November 2019, question 4A. The following financial data relates to 2018 year of what? Assessment of SX Limited, a mining company. Now look at the profit. Profit is 100,000. The above was arrived at. Now we're going to apply all what we've learned. The above was arrived at after the following items were adjusted. Now, an amortization of what? 10,000. Okay, so what they are saying is that they have amortized. There's an amortized value of 10,000 which has been taken out before arriving at this 100,000. Now it was realized from scrutiny of the records that the company incurred a cost as goodwill amounting to what? 100,000 in the 2018 year of what? Assessment. Okay. Remember, goodwill cannot be capitalized. Okay. Loss recorded in 2012 amounted to 140,000. So in 2012, remember in 2012, we were in the IRS Act. The IRS Act in 2012. The IRS Act ended in December 2015. Now, under the IRS Act, mining companies could also carry forward losses for a period of what? 5 years. Following the year in which the loss was what? Incurred. They could do that. Mining companies, because they were companies also in the priority sector at the time. Now the question is, this loss of 20, which was incurred in 2012, we are now in 2018. Can the loss be charged against the profit? But that's what they have done. They say loss recorded in 2012 amounting to 140,000. Remember 2013, 2014, 2015, 2016, 2017. It will be 5 years following. But this year is what? 2018. We learned that if after 5 years you could not generate sufficient profit to absorb the loss can no longer be carried forward. That's the principle we learned. And we're going to apply it to solve this question. Okay. Royalty of what? Remember, goodwill no longer attract capital allowance. Goodwill. Under the IRS Act, goodwill, which is an intangible asset, attracts capital allowance. But under the Income Tax Act of 2015, goodwill no longer attracts capital allowance. So if you have amortized the goodwill, there's no way you can charge it against the capital allowance, against profit. So if they have done that, we have to add back the amortization. Royalty of 25,000 paid to government. We were told that royalty can be expense in 2018 year of assessment in respect of its activities. From the records, an amount of 5 million was the total revenue from the sale of the minerals for the year. So from the records, the sale of the minerals was 5 million. What is 5% of 5 million? Remember, 10% of 5 million is 50,000, 10% of 5 million. So that will be 500,000. 10% will be 500,000. So 5% will be 250,000. Okay. But look at the royalty. Royalty of 25,000 was paid to government in 2018 year of assessment in respect of its activities. But they should have paid how much? 250,000. Because we learned here that to calculate royalty, it is 5% of the value of mineral one or the revenue. So if the value of mineral one is 5 million, 5% of 5 million will give you 250,000. So bear it in mind how much they should have subtracted from the profit. Corporate tax of 160,000 being payment for first and second quarters of 2018. They have charged tax in the accounts as an expense. We learned that income taxes are not allowable expenditure. They are not allowable expenditure. So if they have charged it, we have to add back. An amount of 89,000 was paid to Yeye Limited. That holds 25% of the voting rights of SYZ Limited as gross dividend. Now, dividend that you have paid, dividend is after tax. So there's no way a dividend that you have paid, you can come and charge it to reduce your profit. No way. If that is done, you need to correct it. A capital asset acquired to help in the production of the resource amounted to 2 million in 2018 year of assessment. Remember, we are in 2018. So if an asset has been acquired in 2018 and you want to calculate the capital allowance, then you have to divide it by 5 years. Okay? And that will be 100,000. So it means that capital allowance on this capital asset will be 100,000. Okay? And remember, capital allowance is an allowable expense. So that one, in that case, you need to subtract if it has not been done. Depreciation was 720,000. They have charged depreciation of 720. Depreciation is not an allowable expense in account. We rather grant capital allowance in place of depreciation. Okay? So that is that. 5 divided by 20 will give you 4. So this one, capital allowance will be 400,000 here. We divide it by 5. Okay. So we are just explaining how each of these things will be done. Written down value of depreciable asset carried down effective 2017 year of assessment stood at 30,000. So the question is, this written down value, how many years has it gone to go? They say only 1 year capital allowance has been granted by GRA. So it means that when you are in 2018, this written down value has 4 more years to go, since only 1 year capital allowance has been granted by the GRA. So if you want to calculate capital allowance on this figure, just divide it by 4, and then you are done to get a capital allowance. A depreciable asset costing 400. So this one is also testing us on computation of what? Capital allowance. A depreciable asset costing 400,000 at the time it was acquired was sold in what? 2018. We learned that when it comes to mining and mineral operations, and there is a sale of depreciable asset, what do? You subtract the proceeds from the written down value, and whatever remaining balance is left, you divide it by the remaining useful life. If this was to be a petroleum company, we would have added all these 400,000, the proceeds of 390,000 would have added all to income and tax. But here, the proceeds will be subtracted to determine what value is left, and then we divide it by the remaining useful life to get a capital allowance for that year. Required. Compute the taxes payable. And what is the tax implication of the goodwill as indicated above? I told you that goodwill no longer attracts what? Capital allowance in the Income Tax Act of 2015. Therefore, the tax implication is that the goodwill will not attract capital allowance. So any amount that has been written off by way of the goodwill, which was written off, I think, for 10 years or something, that will not be allowed as a deductible expense. So we look at the workings. So you see that for the ones that the acquisition, this is a computation of a capital allowance. This one will fetch you a lot of marks. Okay. For the one in the year in which the asset was acquired, being in 2018, that will be the cost. And now I'm going to divide it by 5 because that was the first year of acquisition. And that's the capital asset you can see here. And that one, you see that you get a capital allowance of what? 400,000. So 2 million divided by 5, that's the capital allowance here. Then the question, we're told that they have a written down value of their balance of capital allowance and expenditure of 30 million. But they sold some depreciable assets, I told you. So the proceeds from the sale, I told you, must be subtracted. And whatever written down value is left, you look out for the remaining useful life. And we're told that only 1 year capital allowance has been written off. Therefore, you divide this figure by 4. And that will be the capital allowance for the residue. And when you add the two figures together, it will give you the total capital allowance of what? 7,802,500. That's all. So these will be the workings for what? The capital allowance. NB. Remember that the nature of depreciable assets have been depreciated over a year. For a year. The remaining useful life will be for 4 years at the beginning of 2018. However, for the capital allowance, capital work in progress, its initial year is 2018. Hence, it must be depreciated for 5 years. So while this one is good for 5 years, this one is good for what? 4 years. That's all for the workings for capital allowance. Then now, you come to the adjustment of the profit. Okay? Please, your headings are very, very important when you are working questions of this nature. So, XY Limited, computation of what? Taxes payable for the 2018 year of what? Assessment. Then you write your basis period from January to what? December 2018. And then you start with the profit per the what? Accounts. We're told that the profit per the accounts was what? Was 100,000. Now, you were told that they have included the amortization of the goodwill in the profit. And we said goodwill no longer attract what? Capital allowance. So if they have amortized it, it will reduce the profit. So what do? You add it back. So that 10,000, which is the amortized value for the goodwill, you add it back. Now the loss from 2012, this loss has been subtracted. Now remember that this loss has only 5 years from following 2012. I told you 2013, 2014, 2015, 2016, 2017. If the company was not able to make profit up to 2017, any loss that was not absorbed can no longer be carried forward. Therefore, you cannot charge this loss in 2012 against this 2018 profit. Hence, we have to add back. Dividend is after tax. So you don't pay dividend and then come and charge it as an expense in accounts. So if they have done that, what do? You add back. Capital asset is a capital expenditure. You cannot charge capital expenditure in an income statement. So what do? You add back. Income tax is an excluded expenditure. The tax that the government wants, you pay government and then you come and charge as an expense. No way, it will not be allowed. So you add back. Depreciation is also not what? An allowable expenditure in the financial statement. So when you put all these figures together, you get 3.1. Stock it, add back to this figure, you get a 3.219. Then the capital allowance workings, the one that you calculated the figure, you go and take it out. Now you will see that the capital allowance figure is more than the adjusted profit. Okay, because it is always when you arrive at adjusted profit, now you less the capital allowance. The figure is more than the adjusted profit. So what do you do? There's a loss. And this loss can be carried forward for a period of what? 5 years. Following the year in which the loss was what? Incurred. Now you tell the examiner that since there is a loss, you see some people, they don't show this, but you have to show it. Since this loss, you are telling the examiner, losses, because it's a mining company, businesses can carry forward losses. You are telling the examiner that this loss can be carried forward. Okay, put it in bracket, negative. Hence, there will be no chargeable income. So you say chargeable income is dash. But the question says, compute the corporate tax. That was the question. So you are now answering the question. Some people, once they get a loss, now they have stopped. You lose marks for all these. You are going to lose marks. Okay. Place the corporate tax payable. Remember, mining companies and petroleum companies, they pay corporate tax at what? 35%. So you are telling the examiner, corporate tax payable at 35%. Because there is no chargeable income, it will be what? Nil. Then, remember that the withholding tax, the figure that the dividend that you are paying the people. A company is a withholding tax agent. So any dividend that you are paying the people, you are supposed to withhold a tax of what? 8% on that dividend. So this is the only tax which by the 15th of the month following, you must go and account to the Commissioner General. So withholding tax on the dividend at 8%, giving you the 7,120. But for the corporate tax, there will be no corporate tax since there is no chargeable income for the company. It's a very good pilot question for practice. Some past questions. May 2020, question 5B. Compute the royalty payable on the following data of A Limited, a mining company for the year 2018. Production of resources in volumes, 1 million. Revenue from sale. Now note, the revenue above contains proceeds from the sale of scrap amounting to 10,500. Required. Compute the royalty payable, 2 marks. Now, the only trick in this question is that we said that royalty, first of all, before you can do the royalty, you have to quote the formula. Royalty payable is equal to what? The rate of royalty times the value of mineral one, or the turnover, or the revenue. Now look at this. Revenue from sale is 10,500,000. 10,500,000 Ghana. Now look at this. Note, the revenue above contains proceeds from the sale of scraps. This is not from the sale of minerals. So if I'm going to calculate royalty, I cannot calculate royalty on the whole of 10,500,000, but to subtract the 10,500 from it before you slap the 5% on it. That's the only trick, and then you get all the 2 marks. So if you look at the solution, so I think I didn't provide you a solution, but I've explained to you how to resolve this question. So the only trick is that make sure you take out what? The 10,500 from this 10,500,000, and then the remaining figure, okay, is what you compute the royalty on. That's the only trick, because this revenue is from the sale of scrap, and if this revenue is included in this, then you have to take it out first before you slap 5% on it to get a royalty payable. But first, code the formula. It's a royalty payable is what? 5% times the value of mineral one, or revenue from mineral one. Then you do calculation of the revenue from mineral one by taking the 10,500 from this figure, and then before you slap the 5% on it. May 2019, question 5A. K2 Mill Limited has been operating in the mining sector for some time now. The following data is relevant to the company's operations for 2018 year of assessment. Adjusted profit, 100 million. The following additional information is relevant. Financial cost of 900,000, inclusive interest on working capital loan of 20,000 was adjusted in arriving at the adjusted profit. So here, if you want to determine the actual financial cost, you have to take out this 20,000 from this figure, which means that the financial cost is 880,000, not 900, because they say it includes an interest on working capital. Remember, interest is an allowable expense, okay, but it is not a financial cost. The interest on the working capital is not a financial cost. So if they have included it and you want to know the actual financial cost figure, then you have to take out the 20,000 from this to get the actual financial cost figure being 880,000. Now look at this. Financial gain from the derivatives of 600,000 was adjusted in arriving at the adjusted profit above. So what they are saying is that in this particular profit, they have added 600,000 because financial gain is normally added to income. Okay, and then they have also taken out the financial cost from it. But we're told that financial cost can only be allowed to the extent of financial gain. So if you look at this figure, which is now left with 880,000, and you look at the financial gain of 600,000, the financial gain is lesser than this. So the financial cost can only be allowed to the extent of what? The financial gain. So when you subtract 880 from this, you are left with 220. This 220 must be added back. It must be added back. It must be added back. It must be added back. Or what some will do is that they first take out the whole of take out the 600,000 and then add back 880,000. The net effect is that you are adding back 220,000. Depreciation of 155,000 was adjusted to a profit. We learned that depreciation is not allowable expenditure, so you add back. Now, capital allowance again. Written down value brought forward from 2017 after 1 year, capital allowance was what? 1 million. This was accordingly certified by the audit unit of the Ghana Revenue Authority. So it means that this one has 4 more years to go. Because if 1 year is gone already, then divide this one by 4 and you get 250,000, and that's the capital allowance for the 2018 year of what? Assessment. That's all. Revenue of what? 1.2 million was realized on a quantity of gold production of 8 million ounces. A review of the tax returns of Cato Limited revealed that the mineral royalty was not calculated for 2018. So they've not calculated the mineral royalty. Okay, so the revenue of 1.2 million was realized on a quantity of gold production of this. So you know how to calculate royalty. 5% of the value of the mineral one. Cato applied for a waiver of penalty and interest on the mineral royalty to which GRA obliged. Required. Compute the taxes payable, and then what is the tax treatment of the financial cost under the mineral operation. So this one is 6 marks, and this one is what? 2 marks. So please, these are all practice questions which I entreat you to look at quickly, and then we'll discuss them. Very simple. But I explain all to you, looking at what you do to each of them. Okay. Then November 2018, a mining company with 2 contracts operating in the Western and Ashanti regions of Ghana has what? 1 processing facility for its mining operations from both separate contracts. See, this action has engaged the attention of GRA for some time now regarding how to handle its activities for tax purposes. Required. As a final level tax candidate, how will revenue be received from a shared processing facility by a mining company be accounted for tax purposes? Okay. So I told you that revenue earned from a shared processing facility of a mining company shall be considered as one, and therefore the revenue shall be combined as one and should not be separated as a separate mineral operation for tax purposes. Why? The 2 separate contracts should be considered separate mineral operations, but should be seen as one if the processing facility, this is the key word. Though they are under normal circumstances, when you are discussing the concept of separate mineral operation, two separate contracts should have been considered as separate mineral operation, but should be seen as one if the processing facility is what? Is a shared one. So we tell the examiner that though there are two separate contracts which ideally should have been a separate mineral operation, because they are sharing the same processing facility, the two separate contracts should be considered as what? One. And for that matter, any revenue earned from sharing the processing facility of the mining entity shall be considered as what? One. And therefore, the revenue should be combined as one and should not be separated as separate mineral operation for tax purposes. If they were not sharing the same processing facility, then this revenue should not be put together as one. Each revenue, every location must see its operation as distinct from the other, and therefore revenue must be recorded for each of the separate contracts. Okay, but that is not the case in this case because they were sharing the same processing facility for the two separate contracts. Therefore, the revenue must be combined, and the two separate contracts should be seen as what? The same separate mineral operation. This is what we were learning in the earlier lecture. Manla Limited. Okay? I'll provide this one as a solution. But if I were you, I'll try it first before we look at the solution. The same silver question the B. Manla Limited, since its incorporation, this question was November 2018, question 5C. Okay. Manla Limited, since its incorporation, has been providing support services. Okay, have been providing support services. Have been providing mining support services in line with its mandate. And the following is relevant to its operations for the 2017 year of assessments. So, chargeable income, 240 million. The following is relevant. Loss from investment deducted in arriving at the chargeable income, 700,000. Remember, it's a mining, they provide mining support services. One of the things, the reason why I brought this question here, this question should have been under business income, not under mining operation. But I intentionally brought it here to just awaken students to the fact that whenever you are reading your questions, take your time and read it well so that you are not taken aback by a particular word. For example, Manla Limited, since its incorporation, has been providing mining support services. This question is not a mining operation question. It's a normal business question. They don't do mining. They only provide mining support service. For example, they can be servicing the equipment of a mining company. It's a mining support service. Okay? So students, when they saw the word mining, they thought that this question is under mining. And they were solving like a mining question. So most of them, they even use 35% as a company tax rate instead of use the normal 25% because it is not a mining company. That's the reason why I brought this question. Just to conscientize students that whenever you get a question, take your time and read it well so that you are not tricked into solving it wrongly. Okay. Apart from that, there's nothing else. And then the treatment of because this question is on a business income, the treatment of the investment loss. You see, the law says that we don't charge an investment loss against a business income. You can charge business income against investment loss, but you cannot charge an investment loss against a business income. So if they have subtracted this loss, which is from investment, from their mining support services profit, you have to add back. Why? Because losses from investments cannot be charged against the business profits. But losses from businesses can be charged against investment income. That's how we treat investment losses Very, very important. Okay. So the essence of this is that because we don't charge an investment loss against the business income, I have to do what? I have to add back these loss that they have charged. A dividend received from A Limited, a mining company, where Manla Limited has 26% voting power in A Limited, amounting to 20,000. This amount was arriving at what? The chargeable income above. Okay. So what they are saying is that this particular dividend, which was received from A Limited, okay, a mining company, Manla has what? 26% voting power in that A Limited. Okay. Remember, we will come to learn something under a company holding 25% or more in another company. We will learn that under business income. The law says that where a company holds more than 25% shareholding in another company, okay, that company is not supposed to deduct withholding tax on the dividend that it will declare for the investor company. Okay. Why? Because the holdings is what? 25% or more. But the law says that it does not apply to mining companies. This particular principle does not apply to mining companies, and does also not apply to what? It also does not apply to petroleum operations. Okay. So the question is, who is Manla Limited has what? 26% voting power in what? A Limited. But A Limited is a mining what? Company. Okay. So the dividend received, which means that they have received a dividend, and that dividend is an income which they have added to this one from A Limited, where Manla Limited has what? 20% voting power. So there's a dividend received of what? 20,000. Okay. The question is, should that dividend be taxed? If the dividend is not supposed to be taxed, then it must be what? If they have added, what do? You have to subtract. But if the dividend is supposed to be taxed, okay, then you leave it. But again, dividend is subject to a final withholding tax. We'll come and learn them later when I learn withholding taxes. And any income or transaction which is subject to a final withholding tax, you don't add that income to any transaction and tax again. So if the company is supposed to tax, what it means is that the company that is paying Manla, if you are taxing the dividend at all, you must tax it separately, but you don't add it to the income and tax. Okay, so Manla has received a dividend of so much. So what they are saying is that Manla should not add this dividend to their income and tax again, because dividend is subject to a final withholding tax. Any income or transaction which is subject to a final withholding tax, you have to tax it what? Separately. A provision for bad debts amounting to 400,000 was written off as part of what? The chargeable income. General provision for bad debts are not allowed. We will learn it when we are doing examination of accounts. General, I think we learn when we're doing banking, we said that general provision for bad debts are not what? Allowed. So if they are done that, what do? You add back. Manla Limited had a tax loss of what? 20,000 from 2014 year of what? Assessment, which is deducted in arriving at the chargeable income above. Now remember, I told you that the IRS Act ended in 2015. Now, remember, Manla Limited is not a mining company. So, even in the IRS Act, they cannot carry forward losses for a period of 5 years, as we just did in the previous question. This one, Manla Limited, is a mining support service company. So, if they have made any loss, which was in the IRS Act, under the IRS Act, unless for those businesses in the priority sector, which include mining companies, you cannot carry forward a loss. So, because Manla Limited is not a mining company, any loss that they have incurred cannot be carried forward under the IRS Act, because this one, they say the loss was incurred in what? 2014 year of what? Assessment. Okay. If the loss was to be incurred in the 2016 year of assessment, where we are now using the new Income Tax Act, the Income Tax Act, that one, Businesses which are not in the priority sector can carry forward losses for a period of 3 years. Okay, so you could have resolved that if it were to be in a new act, but because the loss was in the IRS Act, under the IRS Act, businesses that provide mining support services are general businesses, and for that matter, one, the net dividend from a company based in the USA of the equivalent of what? 9,500 after tax deducted. What it means is that you have to calculate gross this figure back to 100%. So if this figure is giving you 9,500 after tax, therefore what is 100%? Maybe to give you 10,000. So you add the 10,000 to the income of Manla and tax it. But once they have already paid some 500 again, after you have finished calculating the tax liability, you deduct the 500 that they have already paid, because they've already paid a tax of 500. A powerful shareholder was granted items worth 60,000, which was adjusted in arriving at the chargeable income to neutralize the shareholders' influence at the annual general meeting. Okay, this is like a stock dividend. Okay, and like I told you, dividend is normally subject to a final withholding tax, and therefore this person must be taxed separately. It must be taxed separately. So we don't add it to the income and tax. It's like a stock dividend, and dividend is subject to a final withholding tax, and any income is subject to a final withholding tax, you have to tax it separately. Okay, but for purpose of examination of accounts, this is like a bribe, sort of. You see, a powerful shareholder has granted items worth what? 60,000, was granted items worth 60,000, which was adjusted in arriving at the chargeable income. It means that they have subtracted this as an expense. The question is, should it be allowed? What's the purpose of the expenditure? It's to neutralize the shareholder's influence at the AGM. Because this guy has a lot of influence, and whatever he says can destroy the AGM. So quickly they have to organize some shares and give it to him. Okay, so please, expenditure incurred for corrupt practices, okay, or by way of gift and all that, this one it will not be allowed. So we have to add back that expenditure. Required, compute the taxes payable by Manla Limited and comment on the treatment of the investment loss. So this added a solution to it. So this was the chargeable income which we want to adjust. You see, so the dividend from the mining company, you see, which was added to this one. What do? We subtract it. Why am I subtracting? I'm subtracting because dividend is something what? A final withholding tax. Okay? And for that matter, must be taxed what? Separately. So you don't add it to the income and tax. The dividend that they have received. Okay? Dividend from foreign source. Now, we subtracted the net figure. And then later we'll come and add it after we have determined the chargeable income from the business. Okay, we'll come and add back the foreign dividend. And I told that you have to gross it to 10,000. Okay, as if no tax has been paid. So, first of all, what do? We subtracted the net figure. Okay, the reason why we subtracted the net figure is that we want to first determine how much income Manla is getting from the mining support services. Before, if there are any dividend income we come and add the foreign dividend. Okay, so that is the essence of first subtracting the figure. But when you are coming to add, you add as if no tax on the dividend has been paid by Manla. So we gross up the figure back to 100%. The 95% give you 9,500, then 100% will give you 10,000. So that's why we subtracted this one. And but later we'll add it back after we have determined the income from the mining support services. Then the tax laws. I told you that because it was under the IRS Act, mining support services could not carry forward losses. So if they have subtracted it, what do? You add back. The investment loss, I told that they said they have charged the investment loss against the support services profit. And I said, no, we cannot charge an investment loss against the business profit. So what do? You add back. You add back. You don't charge it against the loss, against the business profit. So you add back. Then the shareholder who was bribed, you see, this is not an allowable expenditure. So you add back. And then the provision for the bad debt, the general provision. So when you do that, and you add back this, you get this is a chargeable income from where? From the business itself. Then the foreign dividend that they have earned, you now come and add to get a total chargeable income. Okay. Then because it's a mining support services, you tax it at 25%. It's not a mining company. So you tax this one at 25%. Then the foreign tax that they have already incurred, you take it out. Okay, you take it out. Foreign tax credit. You take it out. Okay. Why are we taking it out? You realize that when you do something like double taxation, a business where Ghana's tax liability is higher. Remember, Ghana's tax liability is 25%, but the foreign tax was about 5% or so. So whatever foreign tax that the person has paid will be a foreign tax credit to the person to prevent double taxation. So you just take that one out to get a net tax what payable. Then the withholding tax on the dividend of the city, the one that they are. So if you are looking at the taxes that they must pay GRA, the one that they give the person 60,000 because it's a stock dividend, we'll take 8% from it and then pay it to GRA. So all the tax that we pay to GRA will be the corporate tax of 60 plus the withholding tax on the dividend, which we give to that shareholder who has a lot of influence. So the two taxes will give you 62,94425, giving you a maximum of 6 marks. They gave 12 ticks. Each of them had 12 a tick. The entries. In taxation, they mark the entries. So that brought the mark to 6 marks. Now, students should note that Manla Limited is not a mining company. The fact that it provides mining support services does not make it a mining company. Hence, the solution should be in the context of companies in general. Most students consider the company as a mining company that's lost valuable marks. So this is just something that you must note. Then the B part of the question says that show how the investment loss should be treated. Loss from investment of the 700,000 shall be carried forward in line with Section 70 of the Income Tax Act. You can only carry it forward for a period of, in this case, because Manla is not a business and priority sector, for a period of 3 years, following the year in which the loss was incurred. Okay, under the Income Tax Act of 2015, businesses that are not in the priority sector of the economy can carry forward losses for a period of 3 years, following the year in which the losses were incurred, to be charged against subsequent profits. But now note that this is an investment loss, and I said that you cannot charge an investment loss against the business income. The investment loss therefore has to be carried forward for a period of 3 years to be charged against subsequent investment incomes. Investment loss goes to investment incomes, not business. So therefore, we said it should not be deducted in the determination of the business income of Manla Limited. This is how we treat the investment loss. So loss from the investment of the 700,000 shall be carried forward. So we added it back and we carry it forward in line with Section 17. And Section 17 is saying that loss from investments should be carried forward to be charged against future investment income only. Okay, it should not be deducted in the determination of business income. That's all. Okay, so this one, November 2015, question 5E, what factors to be considered by the Mineral Commission before a license is recommended for issuance? You have to provide the resources, like I told you, the program, your program, how you're going to involve nationals in employment and all that. So those were the factors that we considered. So when you look at the previous notes, is there evidence of the financial and technical resources at the disposal of the applicants, proposed amount to be spent on the operations, program of proposed mineral operations, and the applicant's proposal with respect to the employment and training of nationals in the industry. May 2018, okay? I wish when you go back, now you practice these ones based on what you have done so far. You practice this one and solve them on your own. Very, very important, okay? That's good. That's good. So all these are practice questions. So practice questions. Please do well to solve them for our discussion. Anyone that you have challenge on, do well to let me know so that we will discuss them in the course of our discussion meetings. Okay, so these are all practice questions for you. Some of them are provided a solution, and others we'll meet and discuss them. And more of these practice questions as well. So this is another one, another practice question for you. Okay, you do well to look at it. This one there, try and solve it. Very elaborate practice question for examination of accounts for mining company. It's a CIT question for 25 marks. Okay, do well to go through. Thank you for the lecture, and we'll meet in subsequent lectures. Thank you.